My name is Mike McCormick. I'm the principal here at Financial Clarity Group, and joining me today is a friend and colleague, Troy Patton. Troy is the managing member, the partner, the owner of Patton and Associates, or Patton Valuations, and they are a partner of ours in providing valuation services for client businesses and prospective client businesses. Troy is a accredited business. He's accredited in business valuation, ABV. We'll talk about credentials here in a moment. Troy, would you mind elaborating on that a little bit and sharing a little bit about your history and what led you down to valuations, and maybe even a little bit about the Archer funds?
Okay. Yeah, no problem. Thanks. Thanks for having me, Michael. My name is Troy Patton. I'm a CPA. My CPA pretty much stands for cut, paste, and assemble at this point. I use that same joke because CPAs, we have limited jokes. So that's my best one. I'm also an ABV, as Mike said, accredited in business valuation. And I got started doing business valuation work back in the late 90s. And had clients that started coming to me and asking me about the value of their business. And as the more I researched it and started preparing a few valuations, we did 1 to 2 a year, and then it was 3 or 4, and then I started doing them for a couple other CPAs who didn't do them. We started partnering with them, and lo and behold, now today we do probably 10 to 15 a month. I guess it just kind of, excuse me, sorry about that. Sorry. It just so happens that we started doing more and more valuation work. I really got into the business at Ernst & Young. I got to be on one engagement where we worked on a merger between hospital systems, and that really just kind of piqued my interest in the valuation world. And so when I set out on my own, that was one of the areas that I really enjoyed and just wanted to learn more about. And a long time ago, you didn't have to be an ABV. If you were a CPA, you did everything. But now they want to put some alphabet soup behind you, charge you another $750 a year, and take a test.
Right.
So that's kind of how we get to this point. And looking back, I mean, I've probably testified in probably 7 or 8 different states and performed probably about 1,000 valuation engagements, and that's kind of led me to this. And we do, as Mike mentioned, we do manage about $500 million in assets through an investment advisory group, and oftentimes we are valuing public companies as well. Although to be fair to everyone, I would say 90% of our clients are 20 million and under, and of those, 80% are 10 million and under. We like the closely held businesses. We think that's where we offer the most value. So,
are there any particular industries that seem to be attractive to you guys in particular?
I don't think so. As I've told everybody, I think, we've seen everything just about once. I mean, literally across the board, everything from a Chinese dairy farm, literally in Chinese currency, to a company in Ireland, to the small mom and pop, insurance agent. So literally, I think we've seen everything about once. There was a time when and I still do a lot of dental valuations, but I helped Bank of America put together their lending program for dentists and CPAs and professionals and other medical experts. And so, I always felt like I had a pretty good grasp on that. But at this point, we're so far down the road that, gosh, we've seen everything, like I said, just at least once. So.
And that comes in handy when you're valuing any business. You can make comparisons and adjustments based on what you know of those
Absolutely.
various industries. Yeah.
Yeah.
In our profession, we have the CPA credential, but that has grown into, like you said, an alphabet soup of credentials. So I'm aware of the accredited business valuation, the certified business valuation, and then you have appraisers. Can you help us understand what the significance of those are, and whether it makes a difference to the business owner, or what difference it makes to the business owner when it comes to getting an accurate reflection of the value of the company?
Yeah, that's actually a great question. So one of the things I would probably encourage everyone is when they think about their business and they think of a lot of people use the term appraisal for their business to say, I need a value for my business, or they call it an evaluation. Those are obviously different things. An appraisal is what I would consider the value of a hard asset, such as real estate, maybe equipment, things like that. An evaluation would be more of a consulting engagement as in terms of how your business is doing and how it's performing against key performing indicators. And that's where people like Michael can help you out with all those type of things. When it comes to the valuation part, which is a lot of times you're valuing really the goodwill of the business. And as I actually just explained to someone today, that valuing a business, if it was just valuing the assets, it wouldn't be really that difficult. But when you start to value the goodwill of that business and the cash flows that those goodwills generate, as well as some of what those assets generate, that's when it becomes a little bit less science and a little more professional opinion. Valuations are a little bit of both. And obviously, we want to use as much empirical data as we can. There are times when we can get a value on a piece of real estate. If there was an appraisal a year ago and we can look at tax property records, we can usually kind of figure out what that piece of property is worth. But oftentimes people do get a little bit disjointed between an appraisal and a valuation.
Yeah, definitely. One of the things that you mentioned was the value of the goodwill is really the piece of a company's value that you can't just look up in a book.
Right.
It like you said, it's more of an opinion of value, and it's the thing that a lot of people just don't really understand is and they use the term blue sky occasionally, but goodwill is the
art. It's the art.
Exactly right. Yeah, it's the art part of business valuations, and that's where the skill and the knowledge of similar businesses or similar industries or similar professions comes in, and seeing how those businesses are being sold or valued in other markets and in our market, or the market of the target company, if you will, helps determine the value of that particular company. Without that knowledge or background, it would probably be more difficult to come up with the value of the intangible goodwill.
Correct.
Yeah. In marketing this, I made some assertions, and I'll share those with you, and we'll cover those as we go. But one is that the purpose of the business valuation directly impacts what that value is. The other is that waiting can be very costly for the business owner. And the last one is that I'm saying that there are at least 5 areas of focus that can help a business owner maximize the value of their company. Would you add any comments to those?
Yeah, I think George Harrison said it best when, if you don't know where you're going, any road will take you there. Just a little bit of a quote there. So, is what I always tell business owners, and we actually see this a lot. So when we see business owners doing corporate planning, or they want to sell a portion of their business to maybe one of their employees, maybe it's only a couple of percent, or they want to gift to their family members, or even have employees earn 1% of the business or 2% of the business. A lot of times we always say, do you know what your investments are worth? And they say, well, yeah, I can pull a statement. I said, that's great. I said, usually the bulk of your assets are built in your business. And I said, it's interesting that most business owners truly don't know the value of their business. There is a difference, and I don't ever mean to be flippant about this, but a lot of business owners will look at their business and say, hey, yeah, I think it's worth X. I started this thing in my garage and I grew it to this, and emotionally they have a value of X, and maybe the real value is somewhere close to X, but it might just be Y. So
it could be X times 10 also.
It could, and we've seen that also.
Right.
In fact, just this last year in 2020, we worked with a business owner. He said he was going to sell to somebody he knew, and this was the value. And I said, "My gosh, your business is worth 3 times that amount."
Yeah.
And he said, "What?" He said, "I thought it was just the assets."
Right.
And I said, "No." I said, the goodwill of your business is worth 3 times that amount." And so we help them, and sometimes it's the other side of the coin also. But I mean, you make a really good point, and kind of your question. I know you're leading me to this, but I mean, truly, business owners need to know what their business is worth, because if they want to know what it's going to be worth in 5 years, they have to know how to get there. And there's certain things that they can do, whether they look at margins and look at, when we put a valuation together, we show competition, what they're doing, what their numbers are, and how you stack up. And that actually generates value.
Absolutely. I'm going to run through a short list of some of the purposes that I see for business valuations on a regular basis and know about. And this is, I think I have eight items on here. It could probably be 100, but insurance for a buy-sell agreement, or property and casualty insurance, divorce, a partner buyout, a merger with a competitor, retirement plan, like an ESOP, litigation or lawsuit, gifting ownership or selling to an employee, estate planning. Those are ones that came to mind right off the top of my head. There are probably several more.
Oh, yeah.
And most business owners, in my experience, don't, like you said, they don't really conceptualize or understand the value of their company, other than maybe the fixed assets, what those things cost them when they originally bought. But in a situation where take a like you said, an employee who is going to be buying into a company. Well, if you have $1 million company, a 1% interest in that $1 million company is a significant amount of money that the employee would pay income tax on. And most of the time, they're not prepared to do that. And most of the time, they're not ready to write a check for it either.
Absolutely.
But valuation is where those things come into play.
Yeah.
And there are opportunities in a situation like that. You could probably take some discounts. I know you can take some discounts in the gifting of ownership, but probably in the transfer of a minority interest to an employee, you could as well. So can you talk about those a little bit?
Yeah. See, that's a good point. So a lot of times, just using your example of $1 million business, and if you were selling 1%, you'd say, oh, well, $10,000. Well, after discounts, it may be $6,500. And in the back of your mind, you may say, well, that's not going to help me. They're only going to pay me $6,500. Well, remember, you're also not going to pay the tax on $10,000. So you're going to save 12.4% of whatever the difference is there. So that's number one. And then number two, and I think you kind of hit something earlier in your reasons to have a valuation, is insurance and buy sell. Way too often do we do valuation work for a shareholder that's leaving. In fact, we probably have 3 going on right now, and they don't have buy-sell agreements. And so, a lot of times, if somebody's a 20% owner, they think their value is 20% of $1 million, which is $200,000. It's probably not the case. So, those are the type of things that really, I think, valuations are always needed for, to set the standard of how you're going to value that business.
Well, a lot of times you see where they've done a valuation, but it's been 5 or 10 years, and that business has changed significantly since the last valuation. So you might have a death of a spouse or a death of a partner. Now the spouse is the partner, and the spouse may think it's worth 25 times what it was originally valued at, and now you have a lawsuit issue.
Yeah. We were engaged one time to do a valuation on a business in South Carolina, and where the head of the business had passed away, and they were partners. And the wife said that business was worth, let's just say $1 million, when in all reality it was worth about $500,000. And they didn't have a buy-sell agreement, and literally by arguing about it in the courtroom. And this is a true story. And once the attorneys got involved, they loved to argue. And the business was, even though it was probably worth about $600,000 or something. I know it's a small business. by the end of everyone arguing and the business kind of started to fall apart, it was worth about $220,000. And had they just had the buy sell and evaluation up front, and we tried to tell them, hey, let's do a valuation and do this quick within a week and be done. And they said, and it just unfortunately didn't pan out. And sure enough, then everybody was like, well, I thought it was worth X. I'm like, well, that's why you have a buy sell agreement, because the business was a viable business and actually it kept going, but nobody was going to buy it for that at that point in time.
Well, and by going through the lawsuit, it may have damaged the reputation of the company.
Absolutely.
Happened. Yeah. One of the things that I want to touch on is we'll come back to the discounts for a second, but I've made recommendations to clients who have growing businesses. They have kids, mostly minor kids right now, and I've suggested that they start transferring some ownership of the corporation to the kids. Now, immediately, it doesn't really have a tax savings impact on them because of the kiddie tax. But as the kids reach majority, now they're spreading out the tax liability to their kids, who may end up being owners of the company at some point anyway. So we're looking at estate planning issues. We're looking at gift tax issues. So you have the annual gift tax limitation. And one of the things that we look at in making or timing those gifts is the timing of evaluation. So we've suggested in the past that the valuation of a closely held company be done close to the end of the year, so that the shareholders can gift shares to their kids, essentially for 2 years, the year the valuation was done, and then shortly after the year end, so they can get 2 years out of the cost of one valuation. And then they can take advantage of the discounts, which would be lack of marketability and lack of control. I'm sure you see that play out across many companies.
Yeah, I mean, I know you're throwing me a softball here, but you are spot on. I mean, and it's not just to pat you on the back, and so I hope your clients listen to that. Obviously, with the election just changing, we were extremely busy with a lot of gifting, and it makes absolute sense. If you think your children at all will ever be in a position to run your business, or if you think your assets will be large enough that you will never need all your assets and that you plan to leave your children's assets, it makes absolute sense to gift shares to your children at discounted amounts.
Yeah, and I would tend to say, even if you don't think your kids are going to be the ones that ultimately run the company
Correct.
or own the company, because at some point you're going to sell it, and again you spread out the taxation of the gain, the growth of the company over several families at that point. Hopefully,
absolutely.
Yes. You minimize the total family's tax bill. One of the things that I wanted us to cover, and I think it's the thing that I think most business owners are looking at. These other things are important. If I have a buy sell agreement, or if I need a value for property and casualty insurance or whatever, but most business owners, what they really want to do is maximize the value of their company. So I said that we would cover at least 5 of them, and we'll cover these one at a time. And the first one that I think is required of a business to maximize the value of the valuation is to have a strong foundation in systems and documentation of how they actually do business. Not necessarily to the extent of a franchise, but it wouldn't hurt.
Yeah. The quickest thing I can say about that is systems and processes are always what make good companies.
Yeah.
Yeah. And have it documented.
It's repeatable. You can repeat the business. The buyers look at that, and if there's a repeatable system, there's value in that. There's an intangible value that increases the value of your goodwill.
Yep.
Yeah. The second one that I wrote down is a sales generating and reporting system. A system that is able to recreate and cause sales to happen on a recurring basis. Yeah.
So one of the things I think a key point there, and not to really go into this in detail, but recurring revenue streams are always worth more. And if you document how those recurring revenue streams work, and it actually does increase value. People are interested in that. We do a lot of IT companies, for instance, these small IT companies. If they have recurring revenues, it makes a heck of a lot more sense than the IT company that's selling one-off servers here and there.
Absolutely. Anytime you can have a subscription model added to your business, even if it's not your primary way of generating revenue, there's going to be, again, an added value to that because the buyer can depend on that cash flow.
Correct.
So so recurring revenue is the fourth one that I had on my list. The next one is a trained and competent team. The people who are still going to be there when the buyer takes over.
Yeah, absolutely. So in fact, we always say when we're doing valuations, a lot of times people will come to us for a valuation. They say, hey, I'm thinking about selling my business. The first thing I always ask is, do you have anyone internally who could buy the business? Because oftentimes sellers may have to do a seller carryback anyways. And if you have a trained team within your business that understand your systems and processes and everything that you're doing, it's actually the best buyer. And it's actually sometimes the best value you're going to get also. They understand the business. You're going to have a seller carryback. Everything's going to be taken care of. And I think that's important to have.
Absolutely. So the last one, or my fifth one, if you will, is owner extraction. The business that is not dependent on the shareholders or the owners or the partners is more valuable than the same business where everything or a good portion of the activity is driven by those people. Just from a buyer's standpoint, that the business where sales are generated only by the business owner or by the shareholder is not as valuable and not as valuable as a company that has a sales team to handle those things.
Yeah, I think that probably speaks for itself, right? I mean, if I can work 250 hours a year and do the same thing, or if I have to put in 1,800 hours a year, generally speaking, I always try to tell people, I say, you want to be able to stick your hand in a bucket of water, pull it out, and have no hole be there.
There you go.
I mean, and if you can do that with your business, you've created value.
That's right. Yeah, very good. Troy, hey, I appreciate you joining me today.
No problem.
Now, when we've worked with you in the past, clients have come through us. Is that generally the way that you find engagements?
99% of the time.
Yeah.
I mean, I would say that probably 95% of our business comes from CPAs, and then probably 5% from attorneys, just here and there. And every once in a while, we'll get somebody off the internet, but really, we rather work through the CPAs, the CPA conduit, and the accountant conduit. And the reason is because you know your business client better than what I'm going to know them, and it takes me longer to get up to speed to understand that business client, and so we prefer to go through you.
Yeah, absolutely. So if you're a business owner in need of or thinking about having your business have your business go through the valuation process, give us a call or contact Patton and Associates directly. I'm going to put our website back up here, and we would be happy to set up the engagement and get Troy and his team involved in doing a business valuation for your company for whatever the purpose was. We would help you narrow down what the scope was, what the purpose was, and engage Troy's company to make that happen. If you have any questions, give us a call at 513-752-0386. You can email me at mike@financialclaritygroup.com. And thanks for joining us for Business Owner Business Valuations.
I appreciate it. Thanks, Mike.
Thank you, Troy. I'll talk to you soon. Thank you.
Bye.
Take care.